Thursday, the 17th of October, brings an ECB meeting that has been previously touted as an opportunity for the ECB to pause, take stock, and wait for November. That's not the case anymore. We're looking at a live meeting with markets pricing in a very strong chance we see a 25 basis point cut. Why is this important? Why are they likely to do it? And what might it mean for the likes of Euro Sterling and the DAX? We're going to get into all of that in today's video. So let's jump into it. First and foremost, this is a chart comparing where we stand in terms of the economics. PMI is generally regarded as one of the most important leading indicators of how an economy is doing, and therefore an overview of the likes of the European area versus the likes of the UK, the US, Canada, Australia. I thought this might be interesting to bring up. As we can see here, the Eurozone lands below the 50 threshold, 49.6. And that essentially is driven by strength in the services sector with particular weakness in terms of manufacturing. Now, of course, that really highlights the fact that the likes of Germany have really been struggling, 45.0 in the manufacturing PMI for the region as a whole. So those economies that are really reliant on manufacturing have been suffering. Services, by and large, if you look across the board, apart from Canada here, has really been the driver of strength and the reason why we haven't necessarily seen too much of a hard landing or even that much of a soft landing for many of these economies. It's the services sector that has managed to outperform. And arguably, if you're looking across the lot of them, it's the likes of the UK, which actually has managed to have both parts of them in growth territory, but it's the US with 54.0 on the composite reading, which does lead the way in terms of growth prospects. But the Eurozone below that 50 threshold, so pointing towards a tentative contraction within the region. However, it's different for different countries, right? And certainly the Germans have a particularly strong hand to play within this. You can see here the composite PMI for Germany well below that 50 threshold, and that points towards GDP moving towards the downside. So potential contraction in terms of the German economy, potential for recessionary territory. And so there's some pressure on the ECB to act, and they'll need to act soon. The same kind of thing can be said in terms of the composite PMI employment reading and then employment within Germany. Essentially, we've seen the PMI employment gauge moving heavily into a negative territory. We haven't necessarily seen that move quite yet. It's been, for some reason, the title has been chopped out a bit. It's a 3-month on 3-month basis that we're seeing this employment metric over in Germany. We haven't seen it moving into negative territory, but certainly if you look at that PMI employment sort of section, it would point towards that capitulation in terms of employment in Germany being around the corner. So we're seeing the Eurozone as a whole in contraction territory. We're seeing the German composite PMI pointing towards contraction in the region. And we're looking at a potential capitulation in terms of employment in Germany. So certainly the pressure's on for the ECB to take action. We were talking previously about the idea that the ECB might hold off this month. And the part of the reason for it is the fact that we don't have a Federal Reserve or a Bank of England meeting this month. Why is that important? Well, ultimately, if the ECB continues to cut rates over and above what the Federal Reserve or the Bank of England are doing, you see a widening differential in interest rates between the two regions. If you've got a very low interest rate and you've got another country where you have a particularly high interest rate, then someone that has savings might opt to invest abroad. They might put their money into, say, a US fixed income product rather than one in your region. And so you might borrow in your region if you have particularly low rates, but you might not necessarily save within your region, and you see money flow, capital flow moving out of the Eurozone. So certainly you don't necessarily want to see a massive widening differential, but October, whilst we had previously seen markets essentially pricing in a strong chance that they hold off for this month, that has pretty much gone out the window. Part of it comes down to inflation, right? So if you look at the trajectory that we've been seeing in terms of the Eurozone inflation compared to its sort of Western neighbors, 3.3 on core CPI in the US, you've got 3.6 in the UK. That is an interesting one because, of course, this week we have inflation data coming out of the UK. So certainly that's a notable one, but 2.7 in terms of Eurozone core CPI. And essentially the headline CPI job is done. And we can see that here, 1.8 on the headline number for the Eurozone. 2.7, 2.68 essentially for Eurozone core, UK 3.6, US 3.3. We're pointing towards a Eurozone that is more than likely going to soon enough find itself well below that inflation target. So when you're looking at the economic side of things, it's weak and it's pointing towards further weakness, particularly in Germany. When you look at the inflation side of things, we're already below target in terms of headline inflation, and core is moving in the right direction. And soon enough, we're likely to see all of it head really heavily below target, in particular the first quarter or first half of next year. So inflation tick, sort of growth, jobs tick, both sides really pointing towards the ECB needing to take action. And we can see it here. Essentially, growth within Germany is non-existent. The annual change, essentially zero. The quarterly change, essentially zero. And so gone are the times in the past where it's really leading the way for the Eurozone and dragging the region with it. It's now the big laggard within the region. It's notable that we're seeing outperformance in terms of the DAX, though, because certainly if there's ever example of the market is not the economy, now is exactly that when it comes to German markets. So the ECB has already cut interest rates. We can see exactly that here. A couple of cuts so far. We saw a tightening, as we were mentioning last time around, between the marginal lending rate and the refinancing rate. So they're not necessarily within, they're not too far from each other. They're now 25 basis points from each other. But there's an expectation that we're going to see an additional 25 basis points cut from here. Now, what's notable is that we've seen an adjustment since the previous meeting, so the September meeting in towards the October meeting. There's been an adjustment in terms of market expectations. The expectations in terms of how much they're going to cut in the meanwhile. So are they going to cut in October? Previously, that wasn't expected. You can see that that is now expected, but also where interest rates end up. And that's also key. So market expectations for the so-called terminal rate, or where they're going to stop, is absolutely critical within that. So we're only at the inception, but people are going to progressively start to think, okay, if we're just doing 25 basis point cut per meeting, what might fuel risk on or risk off move? Well, part of it might be the totality of the easing process in itself. And certainly what we've been seeing over the past month is that the expectations for this meeting, but also the long term, are for further easing. That might come with lower inflation, that might come with weaker economic data, but all in all, it feeds into the possibility for stronger equities and for a weaker euro. If we're looking at the comparison between the sort of ECB rates compared to many of its peers, if you take out the Swiss National Bank, which is at the bottom in the green, it's already well below many of its peers. And so we're talking about that sort of differential, that widening in terms of rates. It's already underway. And, you know, you're looking at, say, the RBA. The RBA hasn't started cutting rates yet. And some of the other ones, you know, you're looking at the Fed funds rate. We have seen a cut, but it's still well over and above the ECB deposit rate. We've also got the likes of the Bank of England at 5%, still well above the deposit rate as well. So certainly that gap is widening. And the bigger it widens, the more grounds you have for potential downside for the euro. His expectations for this meeting, 98% chance markets pricing in for a rate cut, according to their LSE group. And then from there on in, you can see 99% chance of another 25 basis point cut, 65% chance of another one, 75% chance. It's only the question marks only really start to come into play in April, when we've got essentially a coin toss between another 25 basis point cut and a pause. So according to this, you're looking at rates to essentially resolve around the 2% mark, and you've got variance in either direction, but the sort of area where it resolves within is 2%, and that essentially tallies up with this, right? So this is the expectations now drop down to 2% with that blue line. So markets essentially know exactly what the ECB are going to do, and so you might ask, well, where's the volatility going to come in? It might not. We might not necessarily see huge volatility. When you see expectations as high as they are, then there's not necessarily a huge surprise. It might come down to the tone that you'd get from Christine Lagarde for the commentary afterwards. It might come from a nod towards where they think the terminal rate might be. But part of it comes down to the moves that we see within markets, right? So key to that is going to be yield. So we can see here the 2-year, the 5-year, the 10-year. Now, generally, the 2-year is a good indication of where people see rates moving in the near term. And certainly when we see those expectations sort of rolling over, so the expectation of rate cuts in the near term, it's the 2-year that we see keenly affected by that. But nonetheless, of course, all of them are essentially. And you can see them rolling over following this period of upside, which really broke out from that long-term downtrend that has been in play for bond yields in the Eurozone, but also for many of the countries around the world. But with expectations that are shifting and yields that are shifting in turn, you can plot the likes of the European or the Eurozone yields. So this is the 10-year yield against, say, the UK 10-year yield. And that ratio should give you an idea of where markets think relative rates might move in terms of the speed of it, in terms of where they might end up. And that generally does play a keen role in terms of really informing markets for where the currencies should move. You can see here this relatively tight correlation. Sometimes it's better than others, but certainly a pretty strong correlation over the past couple of years for the euro versus UK 10-year yield and euro sterling. So what does that mean, right? So if we come into the meeting and they cut rates and they come out with relatively dovish comments, you'd expect further downside in terms of the Eurozone 10-year yield. And so you would expect downside for euro sterling, and that's what has been playing out recently. Now, it's notable that, of course, this is a period of time where we're certainly here in the UK talking all about the possibility of increased debt sales in the UK, increased bond issuance. The Labour government certainly wants to be able to create greater headroom for itself to be able to spend. And part of the budget is going to be maybe raising taxes. Part of it is also to possibly change the rules around which they are governed, essentially, how they calculate the amount of debt that they have. And that could increase the supply of bonds, likely increasing the yields on those bonds as well. So you're talking about the possibility, certainly until this budget is announced in the UK, possibility of higher yields coming into play for the UK, and also the possibility of lower yields in the Eurozone if we see a rate cut, if we see them coming out with relatively dovish comments. And so all of that feeds into the possibility of further downside in terms of euro sterling. So let me just bring up the chart for euro sterling first and foremost. Here we go. So let's get rid of the logo. So here we go. So essentially, you're seeing that playing out at the moment as is, right? So this is the weekly time frame, very clear sort of downward channel that's been playing out over, certainly 2024 has been very consistent, but it has been playing out longer than that, much of 2023 as well. We're around the bottom or lower bound of that, and we have sort of rebounded with this sort of spinning top candle, so it points towards some indecision, but that rebound sort of faltered somewhat, and we can see on a more granular level that this rally failed to take out the prior swing high, which is here 84636, rallied into that nice deep fib retracement into the 76.4 fib. I mean, you know, if you trade these levels, and certainly if you've got an order open, because you've got to be pretty keen within this, you know, tagged it and sort of ran away immediately back in the direction of the trend, and we're rolling over once again. You can see the 4-hour chart taking out key support here. So there we go, 835 is your support level. That's now been broken. So different ways that people can play this, but certainly as we head into this ECB meeting, it looks like this sort of descending triangle formation. There you go, sort of descending triangle formation, breakthrough support, points towards high likeliness of this rolling over. So in my mind, I think we could see some downside to come from here. If we were to see a move in the opposite direction, you'd be looking for a rise up through your 838 to negate this bearish view that's come into play. But certainly worth bearing in mind the wider context. We still have got this downward trajectory playing out. And as we head towards that UK budget announcement, there's a possibility that maybe those fears are allayed somewhat, or in terms of tax rises, or maybe it plays out differently from how people are expecting. And then you could possibly see a bit of a pop coming into play. But certainly as things stand, we've seen a downtrend here. We've rebounded from trendline support, but created a lower high at that 76.4 fib, dropped down into a descending triangle formation, and now breaking through support. So does for the near term look relatively bearish as we head into this ECB meeting. And in terms of the equity side of things, we can see that essentially you're looking at a DAX that has rallied habitually into record highs, right? And this chart shows you exactly why we should be a little bit cautious at these levels. Essentially, if you're looking at price to earnings ratio of the DAX, these are the kind of levels that have historically been deemed relatively expensive, right? So you can see in the past, this sort of 17 threshold has sort of formed resistance. It doesn't necessarily, we're not talking about TA here. But you are talking about, price to earnings ratios. If you're looking at a stock, then you might say, oh, if something's got 50, I would never buy it. If it's got 10, then, it's really cheap. So there are certainly levels that people like to adhere to. And you can't just continuously see an equity market rallying without seeing the underlying stocks also gaining ground when it comes to their earnings. So we really need to see the German companies starting to fare better and announce better earnings to support the upward trajectory for DAX or German companies. And so the DAX does clearly have a bullish trend in play, and I can show you that exactly now. I'm not saying that suddenly this is a sell, and we can see that here. Essentially, this is the breakout here. You've got resistance at 194.92, and that's currently being taken out. So we've seen this pullback, the retracement, and then it's a nice bottoming pattern, rallied up through resistance. So there's a good chance that here's the weekly time frame. Look, it's a very clear-cut bull market that we're dealing with here. There's a good chance that we do continue to push onwards and upwards from here. It's worthwhile noting that, from a price to earnings ratio, we have sort of extended towards the upside without necessarily seeing earnings driving that to a great extent, and therefore your price to earnings ratio has expanded up to that 17 area. But nonetheless, look, we're looking at a market that's coming into a period of time where people are getting excited. Why? Because the ECB's cutting rates, the Federal Reserve's cutting rates, the Bank of England's cutting rates. Everyone's cutting rates, and everyone's moving away from a focus on driving down inflation and moving towards a focus on lifting growth. And that means that the expectation for earnings going forward will be improved. You would expect that the actions from central banks and governments will be more aligned with helping businesses grow their profits, grow their revenues going forward. And that should be beneficial for this market and markets across the board. So as we move into a period of time where we've got, of course, big question marks over the near term, we've got US earnings season, we've got the US election coming into play. There could be some jitters, but nonetheless, I think once we've got those things out the way, certainly, hopefully we have a good earnings season. Historically, September's always a bad month. October starts the next bull run. Well, look, we've had a relatively decent period of time anyway, despite these the fact that we've got the US election. But generally within election years, it's November that really kickstarts the bull run. And certainly, this market has been a strong outperformer. So I'm not necessarily going to say we've topped out of this market. I'm going to say we've got a very bullish trend in play. We're breaking up through resistance. We don't necessarily know how extended we're going to get towards the upside from here. But generally, I like to say when you've got a nice trend in play, you can just follow it on an intraday basis at first and make sure that it's healthy from that perspective. And this is exactly that, right? We're marking it with nice higher highs, higher lows until we see that broken with a breakthrough 19339. Then the bulls remain in charge for this market. And certainly if we see another rate cut from the ECB, it would point towards greater optimism for bulls once again. But certainly at some point, we need to see this optimism turn into stronger earnings on the German side of things. And hopefully the ECB can do their best to lift the German economy out of the current quagmire that it finds itself within. I hope this has been useful. It's a busy week ahead, certainly with Chinese data on Friday. I'm going to provide a preview to that as well. But yeah, Euro sterling and the DAX, two of the key trades to be watching out for as we head towards this ECB meeting on Thursday.